Welcome everyone. When I was growing up in a small town in India, I knew I wanted to become an engineer. But I had no idea what people who had taken a similar path actually did to find success. I really wish I had better access to some of them back then so I could learn from them and emulate their journey. The good thing is, when I started learning about value investing, I found the complete opposite. Not only were there many heroes I could look up to, but what's even better is that these heroes are required to tell us what they have been doing every 3 months. And how is that possible? Well, the third quarter of 2025 is officially in the books, which means a special set of documents called 13F filings have just been made public. And for those new to this, a 13F is a mandatory report that every large investment fund in the US has to file. It basically lists the stocks they owned at the end of quarter. And that is our chance to get a snapshot of what the masters of the craft have been buying and selling. Today, we are focusing exclusively on a specific and powerful group, the quality-focused value investors. These are basically the disciples of Warren Buffett and Charlie Munger school of thought. They basically look for extraordinary businesses with durable competitive advantages run by talented managers, and then they aim to hold them for the long term. So, who is on our list today? We will be dissecting the portfolios of Chuck Akre from Akre Capital Management, Terry Smith from Fundsmith, Pat Dorsey, Dorsey Asset Management, Dev Kantesaria of Valley Forge Capital Management, Mark Massey of AltaRock Partners, Seth Klarman of Baupost Group, Lee Lu of Himalaya Capital Management, Norbert of Punch Card Management, Josh Tarasoff of Greenlea Capital, Francois Rochon of Giverny Capital, Spier of Aquamarine Capital, and of course, the master himself, Warren Buffett. So, let's get started and see what the masters of quality have been buying and selling. First up, we are analyzing an investor who is a true master of compounding, Chuck Akre of Akre Capital Management. Akre is the brilliant mind behind the three-legged stool investment philosophy. He basically looks for extraordinary businesses, talented management, and great reinvestment opportunities. And when he finds a company that fits, he buys it and aims to hold it forever. So, let's see what his compounding machines looked like at the end of Q3 of 2025. Akre's portfolio is valued at just over $10 billion and remains highly concentrated in just 19 stocks. His top holdings are the core of his portfolio: MasterCard, Brookfield, KKR, Visa, and Moody's. These 5 positions alone still account for over 60% of his entire fund. Now, let's look at his activity, because this quarter tells a fascinating story. The biggest headline is that Akre has backed up the truck on 2 of his newer ideas. In the previous quarter, we saw him initiate small starter positions in FICO and Copart. And this quarter, he showed massive conviction. He increased his stake in FICO by a staggering 2,751%, turning it into a nearly 4% position. He also boosted his Copart stake by over 253%. This is a classic Chuck Akre move. Dip a toe in the water, do the homework, and then make a huge decisive bet. So, where did he get the cash? He continued a trend from the prior quarter of selling down certain holdings. He basically cut his American Tower AMT position by another 51%, making it clear he is probably exiting this long-time holding. He also made a massive new reduction in Danaher Corp DHR, selling over 50% of his shares. So the takeaway for Chuck Akre's quarter? Well, it was a story of aggressive capital reallocation. He continued to exit legacy positions and redeployed that capital with immense force into FICO and Copart, building up the next generation of what he hopes will be great long-term compounders. Next, we are heading across the pond to look at the portfolio of a man often called the English Warren Buffett, Terry Smith of Fundsmith. His philosophy is simple but very powerful. Buy good companies, don't overpay, and then do nothing. So let's see what his definition of a good company looked like this quarter. Fundsmith's US portfolio is now valued at just over $20 billion. His top holdings have seen a major shakeup. Stryker Corp and IDEXX Labs have moved into the top spots. Now for the activity, and this is the biggest story of the quarter. For an investor whose motto is to do nothing, Terry Smith made some absolutely monumental sales. He slashed his Meta platform stake by more than half, cutting it by 56%. He also cut his Microsoft position by nearly half, reducing it by a staggering 47%. This is a massive multi-billion-dollar pivot away from the mega cap tech giants that dominated his portfolio just last quarter. And on top of that, he completely sold out of 4 companies, most notably exiting 100% of his position in MasterCard. So where did all that cash go? He basically continued the buying spree in a name we saw him add to last quarter. He added another 64% to his Intuit position, showing immense conviction. He also significantly increased his bet on animal health, adding 25% to his Zoetis stake. The takeaway for Terry Smith's quarter? Well, this was one of the most active quarters we have ever seen from him. He made a dramatic and aggressive move to slash his exposure to Meta and Microsoft and completely exited MasterCard. He is actively reallocating that capital into other high-quality software and healthcare names. For the ultimate buy and hold investor, this is a powerful signal. From one master of quality to another. Next up is an investor who literally wrote the book on competitive advantages. Pat Dorsey of Dorsey Asset Management. His entire philosophy is built around identifying companies with wide, durable moats. Let's see what moat-focused businesses he was investing in. Dorsey's portfolio has become even more concentrated, now holding just 9 stocks. His top holdings have shifted, with Danaher still at number 1, but ASML holding had surged to become his second largest holding at 15%. Now the activity, which continues the major overhaul we saw signs of last quarter. The biggest story is where he is putting his money. He added another 24% to his ASML stake. This is a powerful signal of extreme conviction in the semiconductor equipment leader. He also initiated another brand new significant position, buying Royalty Pharma, which is now a 7.5% position right from the start. And how did he fund these purchases? By continuing to clean house on his internet holdings. He completely sold out of Wix.com and SEMrush and slashed his Alphabet position by 35% and his Meta stake by over 21%. The takeaway for Pat Dorsey's quarter? A powerful continuation of his great portfolio reshuffle. He is taking huge profits from big tech and redeploying that capital with force into the unique moat of royalty pharma, and most importantly, adding even more to his now massive high conviction bet on ASML. Next, we are looking at an investor who takes concentration to an entirely different level. Dev Kantesaria of Valley Forge Capital Management. His strategy is the polar opposite of diversification. He finds a tiny handful of the world's most dominant businesses and bets the entire farm on them. Let's see what this best of the best portfolio looked like. Kantesaria's portfolio is valued at 4.2 billion in just 9 stocks. But the reality is even more extreme. His top 5 holdings are all in the financial data, ratings and payment space. FICO, S&P Global, MasterCard, Moody's and Visa. These top 5 positions account for over 91% of his entire portfolio. Now, what about his activity for the quarter? There were no new buys. There were no new sells. The only activity was another tiny trim of his Intuit position, likely for routine rebalancing. And the takeaway for Dev Kantesaria's quarter? It is the ultimate embodiment of the do-nothing philosophy. He has identified the businesses he believes are the best and he is sitting on his hands. His continued lack of activity is the story. It signals an unwavering ironclad conviction to me. Speaking of extreme concentration, let's look at another fund that takes this philosophy to its logical conclusion. AltaRock Partners. AltaRock is known for its best ideas portfolio, where it makes massive long-term bets on a tiny handful of businesses it believes are the highest quality compounders on the planet. So let's see what their handful of best ideas look like at the end of quarter 3 of 2025. AltaRock's portfolio is valued at nearly $5.5 billion, and just like our last investor, it's held in only 9 stocks. But the concentration is even more intense at the very top. Just look at this. Amazon is their largest position at 30.3%. Microsoft is second at 24.3%. And TransDigm Group, or TDG, the aerospace components maker, is third at 23.5%. If you add that up, these 3 companies alone make up over 78% of their entire portfolio. This is the definition of putting your money where your mouth is. Now for the activity, which tells a very clear story about where their conviction is growing and where it's fading. The main event was a massive capital rotation between 2 tech giants. The biggest move by far was a huge 20% addition to their already colossal stake in Amazon. And to fund this, they slashed their position in Alphabet by a staggering 67%. All their other sells were just minor trims of less than 0.5%, likely for rebalancing. And the real story is the Amazon for Google swap. So what's the takeaway for AltaRock's quarter? It was a powerful and decisive statement. They made a high conviction move to bet even more heavily on Amazon, and they did it at the direct expense of Alphabet. It's a crystal clear signal of which tech giant they believe has the better path forward. Now let's turn to one of the most revered deep value investors in the world, Seth Klarman of the Baupost group. Klarman is a true contrarian, known for his disciplined, value-oriented approach. He looks for assets trading at a discount, often in out-of-favor sectors. Let's see what this master of margin of safety was doing. Klarman's portfolio value has grown to over 4.7 billion and he was exceptionally active. Restaurant Brands International, or QSR, has vaulted to his number 1 position at over 11%. The biggest story is Klarman's massive new bets. He more than doubled his stake in two key companies, adding over 103% to his restaurant brands position and another 114% to his Elevance Health stake. On top of that, he initiated several large new positions in classic old economy businesses, buying railroad giants like Union Pacific and Genuine Parts, the owner of Napa Auto Parts. And to fund this, Klarman completely sold out of 5 positions, most notably Viasat and his Liberty Broadband holdings. He also trimmed his Alphabet stake by nearly 30%. So then what's the takeaway for Seth Klarman's quarter? An intense and aggressive repositioning. He is forcefully reallocating capital into consumer brands, healthcare and core American industrials, funded by selling media, satellite and big tech. Next, we will analyze a true modern day master, Li Lu of Himalaya Capital Management. He is perhaps best known for being the only outside investor that Charlie Munger ever gave his own money to manage. So let's see what this replica of Warren Buffett was doing. Once again, Li Lu's portfolio is the definition of extreme concentration, valued at over $3.2 billion. It's invested in just 9 stocks. His largest bet is on Alphabet, which makes up a staggering 37.6% of his portfolio. Pinduoduo, Bank of America and Berkshire Hathaway are his other massive positions. These 4 investments alone account for over 87% of his portfolio. Now for the activity, after a previous quarter where he made a monumental move, initiating a massive new 18% position in Pinduoduo, what did he do in quarter 3? Absolutely nothing. There were no new buys, no new sells and no trims. This lack of activity is indeed a powerful statement. And what's the takeaway for Li Lu's quarter? It was a quarter of quiet, ironclad conviction. Having made his big move in the prior quarter, his inaction in Q3 signals that he has positioned his portfolio exactly as he wants it for the long term. For an investor like Li Lu, doing nothing is often the most bullish signal you can get. From one Munger disciple to another, we are now looking at Norbert Lu of Punch Card Management. The fund's name is a direct homage to Buffett's analogy about having a punch card with only 20 punches for your entire life, forcing incredible selectivity. Let's see what his punch card looked like. This is another masterclass in concentration. The portfolio is valued at over $300 million in just 6 stocks. His largest position remains a massive 34% stake in Berkshire Hathaway Class A stock. Now for the activity, which shows Lu is actively building on his conviction. In the previous quarter, he made up 2 huge new bets on Crocs and PayPal. This quarter, he followed through. The biggest story is that he added another 19% to his Crocs stake, doubling down on one of his newest big ideas. He also initiated a small new punch on his card, buying a starter position in Fiserv and sold 100% of his remaining shares in Smith & Wesson. The takeaway for Norbert Lu's quarter? A story of follow-through. After making a massive new investment in Crocs in the last quarter, he immediately added to it in quarter 3. This is a perfect example of a punch card investor not just making a bet but adding to it when their conviction grows. Our next investor is another master of concentration, Josh Tarasoff of Greenlea Lane Capital. He is known for running a tight, high conviction portfolio of what he believes are some of the best businesses in the world. So let's see what his portfolio looked like at the end of last quarter. Tarasoff's portfolio is valued at over $340 million and is invested in just 8 stocks. His top holdings are a fascinating mix of quality compounders and a high growth outlier. Amazon is his largest position at 20.6%. Brookfield Corp or BN is a very close second at 19%. Berkshire Hathaway Class A stock is third at 14.7%, and Markel Group, the specialty insurer, is fourth at 12.5%. These top 4 positions alone make up over 66% of his portfolio. Now for the activity, which was defined by one of the most interesting structural changes we have seen this quarter. The biggest story by far was a massive swap within the Brookfield empire. Tarasoff sold 100% of his large position in Brookfield Asset Management, ticker symbol BAM. And he then took that capital and initiated a brand new massive 19% position in the parent company Brookfield Corp, ticker symbol BN. This isn't just a small trim, it's a decisive structural bet on the parent company over the spun-off asset manager. His other major move was to slash his stake in the litigation finance company Burford Capital by nearly half, cutting it by 45%. So what's the takeaway for Josh Tarasoff quarter? It was a story of major portfolio restructuring. He made a clear and calculated decision to consolidate his Brookfield investment into the parent company, while at the same time significantly reducing his exposure to a more complex special situation investment in Burford Capital. It's a powerful move towards what he likely sees as the highest quality assets in his circle of competence. Next up is the Canadian Buffett, Francois Rochon of Giverny Capital. What I personally find fascinating is that he comes from an engineering background. As an engineer myself, I appreciate the methodical first principles approach he brings to investing. So let's see what the Canadian Buffett was doing. Rochon's portfolio is valued at over $3.1 billion. His top holdings include Berkshire Hathaway, Meta, and Builders FirstSource. The activity shows Rochon is making some very clear calculated moves. The biggest story is a decisive exit from 2 major American brands. He completely sold out of his large position in Starbucks, and even more surprisingly, sold 100% of his stake in Bank of America. This continues a trend from the previous quarter where he sold his M&T Bank stock. Rochon is clearly and methodically moving out of the big traditional US banks. So where is that capital going? He added again to his Charles Schwab position, cementing it as his preferred financial services play. He also showed growing conviction in insurance, adding to Kinsale Capital and Progressive, and made a significant new buy in the medical device company called ResMed. I personally don't know anything about Kinsale Capital and ResMed. So what's the key takeaway from Francois Rochon's quarter? With an engineer's precision, he is systematically dismantling his exposure to large US banks and probably reallocating that capital with clear logic into other financials and a new calculated position in medtech. Next, we are looking for an investor known for his thoughtful approach and for being a master cloner of great ideas. Spier of Aquamarine Capital. His philosophy is heavily influenced by Buffett and Munger. So, let's see what his portfolio looked like at the end of quarter 3, 2025. Once again, Spier's portfolio is a master class in concentration. His deep admiration of Buffett is immediately clear. Berkshire Hathaway makes up a massive 29.4% of his portfolio. American Express, Bank of America, and MasterCard are his other huge holdings. These 4 positions, all significant in Berkshire-owned portfolio, make up over 75% of his entire fund. His activity was minimal but very logical. The only significant move he made this quarter was a major reduction in his Micron technology stake, selling 60% of his position. So what's the takeaway? A story of quiet conviction and one decisive move. Micron is much more cyclical business than his core holdings. By selling it down, Spier is de-risking his portfolio and focusing even more on the types of businesses he understands best. It's a classic move of sticking to one's circle of competence. And finally, we have arrived at the GOAT himself, Warren Buffett, and the portfolio of Berkshire Hathaway. Analyzing Berkshire's 13F is the Super Bowl of investing. So, let's see what the master and his team were up to in the third quarter of 2025. Berkshire's public stock portfolio is now valued at over 267 billion. The giants are still firmly in place. Apple, American Express, Bank of America, and Coca-Cola still account for over 62% of the entire portfolio. And now for the main event, the activity. And this quarter, there were some truly monumental moves that give us a glimpse into Berkshire's future. And the biggest headline, Berkshire initiated a brand new massive $4.3 billion position in Alphabet. Now, knowing Buffett's historical reluctance to invest in tech, this move almost certainly has the fingerprints of his investment lieutenants Ted Weschler and Todd Combs. This is likely a sign of things to come, showing that as Buffett has stepped back, his successors are already making their mark. There were other significant buys as well. Berkshire added nearly 16% to its stake in the insurer Chubb and another 13% to Domino's Pizza. But to fund these buys, there were some equally massive sells. The most significant was a huge trim in Apple. Berkshire sold nearly 42 million shares, reducing the position by another 15%. This is likely prudent profit taking and risk management. They also completely sold out of home builder D.R. Horton. So then what is the takeaway from Warren Buffett's last quarter? This was a landmark quarter. The initiation of a multi-billion-dollar stake in Alphabet, likely by his lieutenants, gives us the clearest signal yet of Berkshire's future investment direction. And this was paired with massive profit taking in Apple and a continued strategic rotation. It's a portfolio in transition, reflecting both the enduring wisdom of Buffett and the emerging influence of the next generation. So after looking over the shoulders of all these quality focused legends, what are the key takeaways from the quarter? A few powerful themes emerge. First, the great tech rotation. This was the biggest story. We saw a clear and active debate among the world's best investors about the future of mega cap tech. Terry Smith made a monumental pivot, slashing his top two holdings, Meta and Microsoft. On the other hand, Pat Dorsey took huge profits from Alphabet and Meta. But on the other side of that trade, Berkshire's lieutenants made a massive new bet on Alphabet. And AltaRock partners made their own decisive swap, funding a huge 20% addition to Amazon by slashing their Alphabet position by 2/3. Second, aggressive bets on boring businesses. We saw a major theme of capital moving into tangible old economy companies. Seth Klarman was the leader here, making huge new investments in railroad giant Union Pacific and auto parts supplier Genuine Parts, while also doubling down on restaurant brand. This is a clear move towards what he sees as undervalued cash flowing businesses. And third, doubling down on extreme conviction. This wasn't a quarter for timid moves. We saw investors follow through on their ideas with incredible force. Chuck Akre turned his small starter positions in FICO and Copart into major holdings. Pat Dorsey added even more to his already huge bet on ASML. And in a masterclass on conviction, we saw AltaRock partners, who now hold a staggering 78% of their entire $5.5 billion portfolio in just 3 companies. Josh Tarasoff of Greenlea also showed his conviction, making a major structural bet by swapping his entire stake in Brookfield Asset Management for a massive new position in its parent company, Brookfield Corp. And finally, the power of doing nothing. After making their big moves in previous quarters, two of most concentrated investors, Li Lu and Dev Kantesaria, did almost nothing. Their inaction is a powerful signal of ironclad conviction in their current holdings. In conclusion, the third quarter of 2025 was a period of active and decisive repositioning. The world's best quality focused investors are not sitting still. They are debating the future of big tech, rotating into industrial and consumer names, and making huge concentrated bets where they see value. It's a powerful reminder that even for those who think in decades, the search for quality and value never stops. And for us, it's our chance to learn from and emulate the masters of the craft. Thanks for joining, and I'll see you in the next one.